What's happening right now in Washington is far more dangerous than a political disagreement. Because if the US government shuts down in 2025, it won't just pause federal operations, it could trigger the single largest credit shock in American history. And here's the part nobody wants to say out loud. The United States is about to learn the real cost of running an entire economy on paper promises. This isn't speculation. The warning signs are already flashing red. What just happened? Over the past 48 hours, financial markets quietly reacted to something far more serious than a budget negotiation. Treasury yields spiked. Credit default swaps, the insurance against a U.S. default, jumped to their highest level since 2011. And multiple rating agencies issued internal alerts suggesting heightened political risk. Meanwhile, a leaked draft from the Congressional Budget Office reportedly outlines what a 30-day shutdown would do. Freeze 4 million federal paychecks, stall $100+ billion in government contracts, delay Social Security, processing force temporary closure of key regulatory agencies. But the markets aren't reacting to the shutdown itself. They're reacting to what it exposes underneath, what this really means. Everyone on TV will tell you this is just politics. It's not. The hidden truth is this: America has reached a point where it needs constant borrowing just to stay open. A shutdown exposes the fact that the government cannot fund itself without perpetual debt expansion. Insiders in D.C. already know this, that ESY Treasury officials allegedly met behind closed doors this week to prepare extraordinary measures, the same emergency tools used during the 2011 debt crisis. Here's what that means. The U.S. cannot slow spending. It cannot stop borrowing. It cannot pause payments, not even for a week. The system is too fragile. The numbers. Behind the crisis. Let's break down the data that has analysts panicking. $35.7 trillion national debt. Every 12 months, that number grows by nearly $2 trillion even without emergencies. 1.1 trillion annual interest payments. That's more than defense spending and more than Medicare. 70% of all tax revenue already spoken for mandatory spending, plus interest. The government barely covers its own bills. Cash reserves at the Treasury General Account have fallen below critical levels, meaning the government has little cushion if revenue slows during a shutdown. 60% of foreign buyers have reduced their Treasury purchases since 2018. Japan, China, and Saudi Arabia, all pulling back. This is a structural problem, not a political one, and a shutdown exposes it instantly. What the world sees. While the US fights internally, the world is watching and reacting. China has already cut more than $400 billion in US treasuries over the last decade. BRICS nations are accelerating their de-dollarization agenda. Saudi Arabia allowed its 50-year petrodollar agreement to quietly expire. And even Japan, America's largest creditor, is reducing exposure as its own economy weakens. A US government shutdown doesn't just embarrass Washington. It signals to global markets that the world's strongest economy can manage its own finances. BRICS leaders are calling it proof of American fiscal instability. This gives them exactly what they've wanted: a narrative that the dollar is no longer a reliable anchor for global commerce. We've seen this before. We saw a version of this in 1979, when a small technical delay in U.S. debt payments shook global markets for years. We saw it again in 1995, when the shutdown rattled confidence at a time when U.S. debt was a fraction of today's levels. And we saw it most clearly in 2011, when a political standoff caused America's first ever credit downgrade. But here's the difference. Back then, debt levels were manageable. Interest rates were near zero. The Treasury market was stable. In 2025, none of those conditions exist. This is why the next shutdown won't be just another shutdown. It could be a trigger point. What happens next? If the shutdown lasts more than a few weeks, here's what analysts fear. 1. Treasury auctions could fail. If investors refuse to buy U.S. debt at reasonable yields, borrowing costs explode. 2. The dollar could enter a volatility spiral. Global trade relies on stable U.S. policy. Instability shakes currency markets. 3. Banks could face liquidity. Pressure treasuries are their backbone. A shock devalues their collateral instantly. 4. U.S. credit rating at risk again. Another downgrade would be catastrophic. It forces higher interest rates permanently. 5. Social programs could hit. Delays, even brief interruptions, could collapse public trust. 6. Silver and gold could explode. Historically, every sovereign debt scare triggers precious metal surges. Analysts already predict gold could test $2,700 and silver could break $40, $50 if the shutdown reveals deeper structural cracks. What investors should watch. Smart investors don't watch headlines, they watch signals. Here are the key indicators that matter. Treasury yields on the 2-year and 10-year, if they spike simultaneously, liquidity is drying up. Credit default. Swaps on U.S. debt. If CDS costs hit new highs, the market is pricing in real risk. Foreign Treasury purchases. If China, Japan, or Saudi reduce holdings again, expect volatility. Reverse repo facility levels. If the Fed runs out of tools to stabilize short-term funding, brace yourself. Precious metals premiums. Physical premiums rising faster than spot price, calling fear entering the system. If all of these move at once, the shutdown may be more than political theater. It may be a warning. The next 72 hours. The next 72 hours will determine everything. If negotiations fail, if the Treasury's cash levels drop below emergency thresholds, if investors begin dumping short-term U.S. debt, then the shutdown of 2025 may be remembered as the moment the world finally saw the limits of America's paper promises. In the next video, I'll break down the internal memo leaked from Washington that reveals exactly how long the U.S. government can stay solvent if the shutdown becomes prolonged. You're not going to want to miss this.